Good evening, guys. A very warm good evening to everyone. So let's wait for a couple of more minutes. Let's wait so that others can join as well. And then we will continue from where we left off in the last class. Good evening, guys. A very warm good evening. So just wait. Let's just wait one more minute and then we will start in a second. Yes, most probably we will be finishing it by tomorrow. So tomorrow we will be done with asset management and mutual funds. And with that, all the lectures for January batch will be over. So for 1, 2, 2, 3, we will be completing the sessions for tomorrow, most probably. Where we left off yesterday, I guess, was callable bond and puttable bond. No, actually, there are no sessions on morning in weekend. And the reason why the sessions are scheduled in evening and towards night is because we have our international students as well. So there need to be a common time frame which suits everyone, right? Yes, tomorrow will be the last class for batch 1 to 2. So, so let's start, guys. What is callable bond? To understand what exactly is callable bonds, let us just revise first what was call option. Remember anyone? What was a call option? Call option is right to buy, and the buyer of the call gets right to buy. No, SD, if there is any such issue, I will make sure that it gets resolved. Don't worry, SD. Call option is right to buy. Now, considering a simple bond, who issues the bond? The issuer issues the bond. And who gets the bond? DS. Srushti, from which batch are you from? Who gets the bond? The investor gets the bond. Now, if call option comes with a right to buy, when the bond is issued, it is already with the investor. So DS, tomorrow will be the last class for you. Okay. From here onwards, let's not deviate from the topic. And if you have any doubts regarding batches, we will try to take your doubts in the last part of the class. Okay. Issuer issues the bond, investor gets the bond. So who might have the right to buy back the bond? The issuer has the right in a callable bond. Issuer has the right to buy the bond. Okay. So that is a callable bond. But the question is, when will an issuer call the bond? When will an issuer call the bond? I'll give you option. Option A, interest rates going up. Option B, interest rates going down. Think about it. Ronak is saying A, K is saying A, M is saying up. Okay, there have been mixed response. Okay, when investor issues the bond, what does he pay? When an investor issues the bond, what does he pay? He pay interest through coupon. What would an issuer want? Would an issuer want paying higher interest, or would an issuer want paying lower interest? Think about it. As an issuer, you would always want your cost of debt to go down. And when would a cost of debt go down? When you will be paying lower interest rate. So earlier, let's suppose the interest rate was 9% in the market and you were paying 9% interest. But since interest rate has been reduced in the market to 7%, what you will do? You will pay off all the debt at 9%. You will pay off all the debt at 9% to the investors and take back the bond, and you will issue the bond again at 7% interest rate. So no worries, Prachi. We just discussed callable bond and we just saw that a call option comes with a right to buy. And here, as issuer has this call option, in case of bonds, issuer has the right to buy back the bond. But the question is, when will the issuer buy back the bond? When interest rate will go up or when interest rate will fall down? So I was explaining that when interest rate will fall down, issuer will be interested in buying back the bond. And the logic behind that is, why would issuer will be invested in buying back the bond? Simply because everyone as an issuer wants to pay a lower interest expense. That is why interest rate when interest rate falls down, the issuer will call back the bond or exercise the call option associated to the bond. Okay, everyone clear with this? So basically, what are callable bonds? Sure, Apurva, I will repeat once again. Don't worry. Just let us be comfortable with the definition first, and then I will make sure that I explain this once again. Sure, I'll explain again. So what is a callable bond? Callable bond is again an example of debt security which could be which could be redeemed by, yes, bond has a specific maturity, right? So when the bond reaches its maturity, as an investor, you will get back your face value and you will have to give back the bond. So that is called the redemption. Example of what are callable bonds? It is basically an example of debt security which could be redeemed prior to maturity. Basically, Apurv and the one who joined from iPhone, those who had asked me to repeat, I am repeating. Please look into this. This was year zero when you raised debt of 100 million. You issued a bond as an issuer. You issued the bond and you issued the bond at 9% interest rate. Okay. Here, the bond was issued for 3 years. And at 3 year time, you will return the face value to investor. Investor will get the face value of the bond. And the issuer who had issued the bond will have to pay back the principal amount basically. Until 3 years, in year 1, year 2, and year 3, 9%, 9%, and 9%. In first year, second year, and in third year, 9% interest is to be paid by the issuer. Okay, this is simple bond. This is called plain vanilla bond. This is how a bond structure looks like. Comfortable till here, Apurva and the person who has joined from iPhone. And please make sure that you rename your profiles on Zoom meeting as well. So basically, Kriti, this is a bond where you raised 100 million. Yes, Dia, tell me, is there any issue? Okay. So basically, you are the issuer. Let's say you are Reliance Industries and you issued 100 million worth of bonds. So you took 100 million in year zero. You paid interest. You agreed to pay interest for the next 3 years because bond has maturity till 3 years. So basically, you have taken debt for 3 years at 9%. So every year you will be paying 9%. Clear till here, Kriti? Apurv? Clear till here? Shall I move ahead? If you guys allow? Perfect. Now, midway after year 1, over here somewhere, the interest rate, yes, DS, you are correct. So over here in the midway, the interest rate dropped to 7%. And still, as an issuer, you need to pay bond interest at 9% over here and over here. So would you be investing or would you be paying 9% if you are getting debt at 7%? Would you, does it make any sense to pay 9% interest rate if you are getting the same loan amount at 7% as well? No, right? So 7% to raise debt again at 7%, what you did, you repaid all the debt over here only. You called the bond. It means that you have purchased all the bonds from the investors over here at this time frame. You purchased or buy back all the bond. This is called calling back the bond. So you called back all the bonds over here by exercising. Will this be possible in every bond? No, this will only be possible if there is call option attached to this bond, that is exercising call option. And when a bond has a call option, it is called callable bond. So is redeeming this bond before maturity available for every bond? The answer is no. This could only be possible if there is a call option available to this bond. And that bond with a call option is called callable bond. So yes, tomorrow we will be having asset management class. Today we will be completing fixed income securities. Okay. Since we were not, although asset management was scheduled for today, but we didn't hurry up. We were not able to match the pace of the class. So we extended our session till this lecture. Okay. This interest. Yes, I'll come to that. Then 22 lecture. It would be of asset management class. Tomorrow you will be having last session of asset management class, Srishti. But please make sure that we don't discuss all of these things midway while discussing a topic. It would unnecessarily deviate the class. Okay. Please make sure that we don't discuss this about it again. We will definitely, if you want, we are definitely going to discuss this by the end of the class. But let's not every now and then deviate from the topic. Otherwise, people will get confused. This is a sincere request to you. Okay. Again, I am explaining for the callable bond part. Basically, callable bond, in a callable bond, issuer has a right, issuer has a right to call the bond before maturity. And what do I mean when I say call the bond before maturity? Basically, call option is nothing but right to buy. And since over here, issuer has the right to buy, issuer has the right to buy the bond before maturity. Now, this is a 3-year period. The bond was issued for, let's say, not 3 years, 5 years. Okay. Taking a different example, bond was issued for 5 years. It means that 5 interest payment is to be made to this bond in year 1, in year 2, in year 3, year 4, and year 5. 5 interest payment will be made in case of every bond. Sir, prior to maturity means at the time of maturity? No. At the time of maturity is at maturity. Prior to maturity is anywhere before maturity. Between year 1 to 5 is prior to maturity. Okay. Now, is this possible in every case? No, this would only be possible in case of callable bonds. If the bond has a call provision, then and only then it would be possible to call back the bond by the issuer before maturity. Basically, if 9% was the interest rate, if 9% of the interest rate, the issuer had to pay interest for 5 long years at 9%. But since, sir, in this bond, does issuer pay any compensation to investor? Yeah, I will come to that. What compensation does issuer pay to investor? And why would an investor invest in such a bond which has a risk of calling back midway? That point I will come, but let us just get clear with the callable bond and the structure of the callable bond first. So at 9% it was issued. It means that interest rate was 9%. Interest rate is fixed till maturity. So how interest rate can be less? Interest rate is fixed for the bond, right? Interest rate is fixed for the bond. That you are correct. But interest rate can change in market. In market, interest rate can drop or rise, correct? RBI can change the interest rate. RBI can do a rate cut, do a quantitative easing, and because of that, interest rate in the market can change. Are you getting this, Kriti? Kriti is asking that interest rate is fixed for the next 5 years. Then how it got changed? I am not talking about the interest rate of the bond. I am talking about the market interest rate. The market interest rate got changed. Market interest rate, similar bond has been issued at 7% in the market. Similar bond has been issued at 7% in the market. So your competitor is paying 7% interest rate and you are paying 9% interest rate. Would you be happy paying 9% interest rate? No, right? You won't be happy paying 9% interest rate. So what you would want? You would want that all the debt that I have taken, let's repay that debt. All the debt that I have taken through bond, let's repay that debt, buy back those bonds, and then issue the bonds at 7% interest rate, where I will only liable to pay 7% interest rate. Now the question is, why would everyone clear till here? What is callable bond? How does it function? Everyone, guys, are you guys clear? Ashish, are you clear? Shall we move ahead to the next part, where the question is, why would any investor invest in a bond which comes with a reinvestment risk? Why would any investor invest in such a bond which comes with reinvestment risk? Now, what is reinvestment risk? Let's say you had invested in this bond at 9% for 5 years. Now, based on this 9%, now we are talking from the investor point of view, right? Now, this 9% is interest income for you, correct? Am I correct? This 9% is interest income for you since you have invested in this bond. Now, the question is, if this interest income is being called by the issuer, the bond has been called by the issuer in the second year itself. And when it is called, when the market interest rate are 7%, when it is called when the market interest rate are 7%, it is basically a risk or loss for you. This is minus 2% of loss for you, because now when you go to invest in the market with the principle that investor has returned you or the issuer has returned you, you will be getting 2% less return. Am I correct? We are, again, guys, we are evaluating from an investor point of view. Am I correct in this? Everyone with me? Everyone with me, please stop me here itself if you are not getting this. Apurv, Shivam, guys, are you there with me? Investor could get higher maturity value than face value, as interest rate falling would increase the bond value. Yeah, but you are correct about. When interest rate rises, the bond value falls, and when interest rate falls, the bond value rises, but it won't go above face value. Okay, coming again. As an investor, Apurv, please focus over here. As an investor, you invested 9%. You invested in a bond to get 9% return. Let's suppose investor should call the bond as investor is paying interest. How come investor will pay interest? Issuer pays the interest. Investor gets the interest. Who is the issuer? Reliance Industry was the issuer, remember? And then we are the investor. Earlier we were evaluating from Reliance point of view. Now we are evaluating from the investor point of view, who has given loan to Reliance. I have given loan to Reliance at 9% for 5 years by investing in their bond. What is bond? Bond is basically a debt instrument. Okay. Are you guys there with me? Now, earlier I had locked the interest rate till 9%. The interest rate that Reliance was paying me was 9% for the next 5 years. But since the interest rate in the market has fallen down, Apurva, are you there with me? But since the interest rate in the market has fallen down, the new interest rate is 7%. Earlier you were getting 9% return. Now you are getting 7% return. Would you be happy about this, Srushti? Earlier, as an investor, you were getting 9% return, and this time you are getting 7% return. Would you be happy about this, Srishti? The answer is no. So why would, this is a risk for you, right? For the rest 3 years, you need to reinvest this and generate 9% yield. This is a risk for you. Srishti, tell me if you have any doubt in the chat box. This risk is called reinvestment risk. Why would anyone invest in this bond? Why would anyone invest in this bond? Tell me why. Simply because callable bonds Srishti, coming again, Srishti is asking me to repeat this point. So I am coming again with this point. Basically, as an investor, you had locked in the price for 9%. You were getting 9% interest rate, and now you are getting 7% interest rate, Srishti. Would you be happy getting these interest rate at which was earlier decided at 9%, but now you are getting 7%? Are you in profit or are you in loss? Earlier, it was decided for the next 5 years, you can get interest rate at 9%. But since interest rate dropped down, now you have to reinvest the amount at 7% and you will be getting 7% return. You are at a 2% loss, right? So if there is chances of loss in a callable bond when the issuer will call the bond, why would anyone invest in such a bond? That is the idea over here. Clear till here, Srishti? Please tell me, please let me know. Okay, Srishti, now you will tell me that why anyone of right to get more interest from same bond, or the person can sell the back the issuer. I will come to that, GV. So for that concept, we have a different bond, that is puttable bond. Okay, I will come to that, but let me just complete. Now, Srishti, tell me that why would anyone invest in such a bond with reinvestment risk? So this was reinvestment risk for you, right? Because till the next 2 years, you enjoyed 9% return. But here, issuer has called the bond. Issuer called the bond. For the next 3 years, or for till 5 years, and for the next 3 years, you have to generate 9% return on it, and you are not sure whether you will get 9% return or it not, or not. Or maybe when interest rate falls down, you are getting 7% return on it. So why would anyone invest in such a bond? Simply because simply because callable bonds provides better returns. And what is returns called in terms of fixed income security? Yield. Better yield as compared to a similar plain vanilla bond or simple bond without a call option. Now, what does that mean? It means that, let's suppose Reliance has issued a callable bond and a simple bond. If Reliance is paying, since Reliance is paying 9% return on a simple bond, he will have to pay a greater return, that is approximately 11% in a callable bond. Why? What is this extra 2% return for? For that call option that issuer gets. Everyone with me? What is the link between callable bond and reinvestment bond? Basically, I will tell you what is the link. You wanted to invest. Now let us just go a step backward. Let's say you had 1 lakh rupees in your account and you wanted to invest this 1 lakh rupees or 100,000 rupees for 5 years to fund your child education. So after 5 years, you will need 1 lakh rupees. So basically, you invested some amount over here and at 9% return, that amount should become 1 lakh. At 9% return, that amount should become 1 lakh. This is what you wished. But in the second year only, since the bond was given back to you, will you get interest for rest 3 years? Will you get interest for the next 3 years? SG, will you get the interest for the next 3 years? SG is asking what is the link between the callable bond and reinvestment bond. And when the issuer will call back the bond, when the issuer will take bond back from you, when interest rate has fallen down. So now the new interest rate is 7%, but you made investment considering 9% interest rate. But is it certain that you will be generating 9% from here onwards for the next 3 years? There is an uncertainty, right? This uncertainty is called reinvestment risk. What is reinvestment risk? Reinvestment risk is basically a risk that whether you will be able to generate same returns when you take out the money from this bond and reinvest for the later time left till maturity. That is reinvestment risk. Got this, SG? SG, did you got this? Shall we move ahead? Basically, don't get confused. You invested for 5 years. You invested for 5 years at the rate 9%. Any doubt till here? Let's go one step at a time. Any doubt till here? Both Nandini and SG. Any doubt till here? You invested for 5 years at 9%. After 3 years, the market rate is 7%. Now, if you are getting 9%, someone might be paying you 9%. And if someone is paying 9% interest and he is getting an option to finance the same loan at 7% interest, what would he be happy in? Yes, Prachi, you are correct. SG, as an issuer, will anyone will be happy in paying 9% interest or 7% interest? Let's suppose you have taken a home loan. Will you be happy in paying 9% interest on that home loan or 7% interest? 7, correct. So over here, after 3 years, issuer calls back the bond. Issuer calls back the bond. Now, do you have any doubt what does calling back the bond mean? SG and Nandini, do you guys have any doubt in what does calling back the bond mean? Then again, if there is a call provision for the bond, he will again call the bond. If there is no call provision, he will have to pay 7%, Kriti. So Nandini and Kriti, please reply again. Sorry, Nandini and SG. Nandini and SG, please reply again. Is there any doubt till here? Do you have any doubt in what does calling back the bond mean? Okay. Now the question is, if he calls back the bond, if he gives back you your principal amount, let's say your principal amount is 80,000. If he gives back you your principal amount, if he gives back you the principal amount, will you be getting 9% return from the third year till fifth year? If he gives back you your principal amount, will you be able to generate 9% return from third year till fifth year? Will you be able to generate this return? Because he has given you back your principal, right? So you won't be able to generate this 9% return. What will you be able to generate? The new market rate, that is 7% return. Correct? Now, why would you be happy to take this risk? to take this risk of interest rates falling down and reinvesting it at 7%? Why would you be happy in getting that loss of 2% or 2% of uncertainty? Why would you be happy in taking that risk? Why would you be happy in taking that risk? This is the question. Any doubt still here? Anyone, especially Nandini and SG, any doubt still here? I am coming to what, why would you be happy in doing so? Any doubt still here? Nandini and SG, please reply. Issuer is buying back. Yes, issuer is buying back. Correct. Yes, issuer is buying back the bond at the end of third year. Correct. Then how investor will get interest? Yes, that is what I am saying. Investor won't get interest, won't get 9% interest, but the amount that issuer has given him, he will reinvest it at market rate, right? He can't sit and wait this amount to grow. He will reinvest it at market rate at 7%. That is new interest rate. Are you getting this, SG? Perfect. Now the question is, why would you take this risk of interest rate falling down? Simply because higher the risk, higher the return. Correct? Higher the risk, higher the return. Do you agree with me, SG? Do you agree with me, SG? Higher the risk, higher the return. So basically, a callable bond will be giving you higher return as compared to a straight bond. A higher return compared to a straight bond. And that is why you would be happy enough to take that risk. So what happens? Let's suppose a straight bonds gives you a 9% return, or let's say a 6% return. A straight bond gives you a 6% return. Then a callable bond will give you, let's say, 9% return. It means that you are taking the risk of interest rate falling down after 2 years, but you are getting 3% more returns. So what are you betting on? You are assuming that if market rate don't fall down, will investor call the bond if market rate don't fall down? Will investor call the bond if market rate don't fall down? If market rate went to 10%, 11%, or 12%, will he be happy in buying it at a higher cost of capital? The answer is no. If market rate don't fall down, the extra 3% return enjoyed by the investor of callable bond is due to the risk that he had taken. Agree with me? Basically, PM in a straight bond, you were getting 6% return. In a callable bond, you are getting 9% return. Pragati, in straight bond, you are getting 6% return, and in a callable bond, you are getting 9% return. This is extra 3% return that you will enjoy. And you are ready to take the risk for this extra 3% return, that if market rate falls down, no, the principal, it depends. It depends on the credit quality of the issuer. So we will come to that part as well. But let us just get done with the callable bond and putable bond first. Okay, Rohit? So PM, Pragati, this extra 3% return you are enjoying, no one will give you this return for free. Why you are enjoying this return? Because you are assuming the risk, you are taking the risk of interest rate going down. So if interest rate going down, you are having a reinvestment risk, whether you will be able to invest again at 9% or not. But if interest rate goes up, will the issuer call the bond? What do I mean while interest rate goes up? Plot numbers in your mind. When interest rate goes up to 10%, 11%, or 12%, will he issue new bond at 10, 11, or 12? Or he will be paying you the interest at 9% only for the next 5 years? He will be paying the interest for 9% only for the next 5 years. Okay, Pragati, are you there with me till here? Now, since You assumed that risk and interest rate didn't go down. You enjoyed 9% return for the next 5 years. That is extra 3% from one who didn't enjoy the risk. What if it falls below 6%? Then that is your loss. What is risk? When you take the risk, you have equal chances of winning and losing, right? And if interest rate fall down below 6%, then it is a loss for you. Okay. Okay, Pragati. Moving on. In a callable bond, issuer has the right. It means that issuer enjoyed. And that is why he paid greater yield. He had to pay greater return because this was right to issuer. On the other hand, in case of a puttable bond, what do you think? Who might have the right? What do you think, guys? Who might have the right in case of a puttable bond? Investor. Very good. And put provision comes with right to buy or right to sell. Put provision comes with right to sell. And since here investor is getting right to sell, since over here investor is getting right to sell, will he be getting more yield or low yield? Correct. Very good, GA. Investor will be getting lower yield. And I will come to the yield part later. But think about it. When would interest, if you have the right to sell, if think from the investor point of view, if investor has a right to sell, when he will exercise this right? When he is going to exercise this right? Option A, when interest rate going up. Option B, when interest rate falling down. When is he going to exercise this right? When interest rate going up. So earlier you took a bond. Earlier you bought a bond. Okay, those who are saying B, I will justify, I will clarify why you will exercise the right to sell when interest rate is going up. Let's say interest rate is 9% for the bond. There could be two cases. Interest rate can go up. If interest rate, is there any difference between tradable bonds and puttable bonds? All bonds that can be traded in the market are tradable bonds. Puttable bond is a type of tradable bond. You can say that. Okay. Option A, if interest rate goes up, let's say interest rate went up to 12%, and let's say interest rate went down to 6%. You were getting earlier as an investor, you were getting 9% return. If interest rate goes down, will you be selling this bond that is giving you 9% return and getting a bond which will give you 6% return? Will you be doing it? Would any logical person would do it? From 9%, interest rate went up to 12% in case 1, and interest rate went down to 6% in case 2. Let's evaluate case 2 first. So if interest rate went down to 6%, would any logical investor would happy in getting 6% return instead of 9% return? Anyone who feels so, please let me know. Anyone who is willing to take or accept 6% return instead of 9% return. So in that case, he won't exercise the bond. He won't exercise the bond and enjoy 9% return till maturity. Correct? Agree with me? Agree with me till here, everyone? Yes, investor won't sell the bond in lower interest rate. SG, basically you invested in the bond. SG has a doubt. I am repeating it for him. Anyone else who has a doubt, please let me know. Please ask me to repeat so that I will address you as well after every step. Anyone who has a doubt, please let me know so that I can address you as well. Sure, KS. I have received 2 responses, one from SG and KS. Anyone else? Please let me know. Apurv, Are you clear with this? Okay, and DS as well. Okay. Now you are investor of the bond. Investor gets returns. One who invests in the bond gets interest return. That is interest income for you. Correct? Any doubt till here? KS, DS, and SG? Yes, Kriti, you are correct. So as an investor, SG, as an investor, you are getting 9% return. Now, this bond was for 5 years. This bond, let's say, was for 5 years. And after 2 years, two things can happen. Either interest rate can go up or either interest rate can go down. Let's say if interest rate goes down, you will be you will you be selling this bond at 9% and buying a bond of 6%? Will you be doing that, SG? Please tell me. Please let me know. Will you be sacrificing a bond that is giving you 9% return and going for a bond that is give you 6% return? Will you be exchanging iron for gold? No, right? So in this case, you will let the option lapse. You will enjoy your bond with 9% return. And when the bond that you invested in giving you 9% return and market interest rate went up to 12%, now what you will be doing? You will be selling this bond and investing the amount that you received at 12%, so to generate 12% return. Am I correct? Is this logical? Is this logical, guys? Are you guys there with me? Perfect. So when does a seller or a puttable bond be exercised by the investor? When would the puttable bond will be exercised by the investor? In a puttable bond, investor has a right to sell the bond. And if investor is selling, who will be buying the bond? Issuer is buying the bond. Investor has right to sell. Now, if now tell me one thing, whether callable bond is a better bond, whether callable bond is a good quality bond, or puttable bond is a good quality bond for a investor point of view, from an investor point of view. Which bond is better quality bond from an investor point of view? Always a puttable bond will be a better option for investor point of view, because in puttable bond, investor is getting the right. Correct. In a puttable bond, investor is getting the right. In a callable bond, issuer is getting the right. Since issuer wants to enjoy the bond or enjoy the right, he will have to pay a higher yield. Over here, issuer is giving you the right, investor is getting the right, and issuer is giving the right. So investor should be happy with a lower yield. Correct? Everyone with me? So a callable bond would have a higher yield and puttable bond would have a lower yield. So if I want to frame this, when comparing yield, callable bond would have a higher yield than straight bond, and straight bond would have higher yield than puttable bond. Are you guys there with me? Why? Because puttable bond yield means returns. Yield is nothing but returns. So if you are getting callable bond in which issuer is enjoying, issuer has to pay you more returns. In a straight bond, there is neither call or not put provision. So that would be a medium return. And in case of puttable bond, since you are enjoying the right and issuer has to sacrifice, issuer will paying you lower returns. Yes, K, please ask the doubt. how putable bond will have low yield? You are the investor K, correct? K is the investor. If you go, you have two options, either to go for a callable bond or either to go for a putable bond. In which bond, as an investor, you will have the right? In which bond, as an investor, you will have the right? Putable bond. So putable bond is a better quality bond for you, correct? So putable bond is a better quality bond for you. Now, if you want better quality, you will have to sacrifice the returns, right? If you want better quality, you will have to sacrifice the return. You will be have to satisfied with your low yield. Why? Putable bond is a better quality bond. Its prices would be higher. Its prices would be higher. So a callable bond might be priced at 800 and putable bond. Yes, I am coming to that. Putable bond Putable bond is priced at 900. Reinvest in that which gives me high interest rate. But we are evaluating for the particular bond point of view. That you are correct. So what K is getting confused in? K is saying that I have a putable bond and this putable bond I will sell when interest rate is 12%. K is asking this in, so I will get a better interest rate and higher interest rate. But again, K, this 12% is when you will reinvest it. This putable bond, this return is only when you will reinvest it. If you continue using this putable bond, if you reinvest in it, we don't know whether you will be investing in a putable bond or any sort of a bond. We don't know that. That is reinvestment return. That is reinvestment return. This return is not generated by this putable bond. Are you getting this? Okay, guys, did you got his doubt? What she is saying? Did you got a doubt? That she is saying that since putable bond, I can sell and reinvest it at 12% return. Putable bond is giving me higher returns. But no, guys, it is the put option that you exercise, and based on that you can reinvest the amount which will give you higher return. But putable bond return is in a bond return is given by the issuer. In a bond return is given by the issuer, and in case of a putable bond, the one who is the issuer will be paying you a lower amount. Why? Because he is giving you a right to sell. That is why he will be giving you a lower interest income or lower yield. Yes, you can sell and reinvest. That you are correct about KA. But if you sell and reinvest, that return will be given by a different bond. That is no longer a putable bond that will give you that return, and no longer the bond given by the same issuer. If you reinvest, if you sell the bond and reinvest it, that return would you given by the bond B. First you bought bond A, you sold the bond, and then you bought bond B. Let's say bond A was giving you 8% return, and now the interest rate is 12%. So bond B will give you 12%. This putable bond, that is bond A, will only give you 8%. Why are you getting confused? Clear? In a putable bond, but in callable, the ROI is fixed. But in collab, okay, Soumya, but in collab, the ROI is fixed. Then it can be a loss if market is giving 12% return. Yes, yes, I'm coming to that. What are the features of a putable bond? The simple feature of a putable bond is the investor has the right to sell the bond. When interest rate rise, investor will exercise the bond. Investor will exercise the bond. Yes, we are calculating return based on our original bond. Original bond, or basically the first bond that we invested in, whether it may be callable or puttable. The idea is very simple over here. If you want a good bond, be satisfied with a lower yield. A good bond which gives you a right will give you a low yield. But if you want a bad bond, a bond with higher risk, then you be ready to get or enjoy the higher return. This is what the simple idea is. Okay, everyone with me till here? Any questions? Difference between callable? Yes, I will explain that. What difference between callable and puttable bonds? Soumya, but in collab, you are saying what is collab? I don't know. Okay, in a callable bond, if market is giving 12% return, it can be a loss. So yeah, it could be a loss. If interest rate is going up, that is the loss. But if you are investing, you should be open to both profit and loss, right? If you don't want that risk that if market goes up, you are getting the loss, and if market goes down, you are getting the loss, invest in a straight vanilla bond and enjoy the return fixed by the bond. Maybe 10%, 12%, 8%, 6%, 5%. Any return that is given by the bond in a straight bond is fixed till maturity. If you don't want to get the loss, and if you don't want to suffer that loss, invest over here, redeem the bond till maturity, and be happy with the interest rate. Don't hope for higher returns. This is what the simple idea is. Perfect. Distinguishing callable and puttable bonds. I will ask and you will answer me. Sorry. Right is with right is with in callable bond, who has the right? Issuer has the right. In puttable bond, who has the right? Investor has the right. Obligation, if right is with the issuer, obligation is to investor. Here obligation is to issuer. Exercised when interest rate going up or interest rate going down? Interest rates going up or interest rate going down? Interest rate going down. And this is exercised when interest rate going up. Lapsed, and not the bond but the option. Option is lapsed. And when option is lapsed, bond is held when interest rate is going up and interest rate is going down. So when interest rate is going up, the issuer won't want to pay higher interest rate, so we will let the option lapse. And when interest rate is going down, as an investor, you won't want to get lower returns, so you will let the option lapse. Okay, clear till here? This was distinguished between callable bond and puttable bond. Are you guys clear? Now, this, everyone, yes. Pragati, in a callable bond, exercising means using the option. Exercising means using the option. If using a call option, the issuer buys back the bond, it is called exercising the call option. If using a put option, you sell the bond as an investor, it is using the put option or exercising the put option. Now, I am explaining the last point again, since PM has asked me to. What do you mean by option is lapsed? When we talk about callable bond, we are talking from the issuer's point of view. And as an issuer, you are paying 9% interest. If the interest rate went up to 12%, will you exercise the bond? No, you will let the bond lapse. This is what this point is about. PM, are you getting this? PM, are you getting this? If in case of investor, you were getting 12% return and the interest has fallen down to 9%, will you be exercising the bond and getting 9% interest of 12%? No. Again, you will let the option lapse. Now, what is lapse? Lapse is basically not exercising the option. Not exercising the option is what lapse means. Correct? Devjit, tell me one thing. If what would you want? You would want 9% interest or 12% interest? As an issuer, what you would want to pay? A 9% interest? Can you explain in another simple? Yes, I am explaining this in another simple example. Would SG you want to pay as an issuer? Always think while evaluating a callable bond, always think from the issuer point of view. While evaluating a puttable bond, always think from an investor point of view. When we talk about callable bonds, what would you want? Would you want a 9%? Would you want to pay 9% interest or 12% interest? Interest rate is going up. Earlier it was 9 and now it is 12. Would you want 9% interest? Issuer, SG issuer pays the interest. Would you want to pay higher or lower? SG, would issuer pays the interest? Remember, lesser one, correct? So if you want to get the lesser one is given by the same bond. So you won't sell the bond and pay 12% interest. So when interest is rising, you will let the option lapse, not the bond, but the option lapse. You will let the option lapse and keep on paying 9% interest. On the other hand, when interest rate falls, you will be calling the bond and paying 6% interest. Let's say if the interest rate has fallen down. Correct? Everyone clear with this? Yes, in callable bond, only the issuer has right to exercise and lapse the option. In puttable bond, only the investor has the right or right to exercise or lapse the option. Okay, correct? Everyone clear with this? Everyone? So that I can move on to puttable bonds. SG, are you clear with this? Exercised when interest rate is falling. Option is lapsed when interest rate is rising. Exercise mean he will lapse the bond and sell to other investor. Lapsing and exercising are two different things. Not exercised means lapse. If the bond is not exercised, it means that the bond is, sorry, again and again I'm saying bond. If the option is not exercised, it means that the option is lapsed. Clear? Are you guys clear till here? Khushbu, are you clear? Lapse is basically the opposite of exercise. Opposite of exercising a bond means letting the bond lapse. Clear? Are you guys clear? Everyone? Soumya, tell me, where are you stuck? The last option. Okay. Exercising means selling or buying the bond. If there is a call option, you will be buying the bond. If there is a put option, you will be selling the bond. On the other hand, lapse means to continue with the bond. To continue with the bond would mean letting the option lapse. To continue with the bond means letting the option lapsed. Clear? Clear? Soumya, I will tell you about callable bond and think yourself for puttable bond. Interest rates going up versus interest rate coming down. When you will exercise the option? Interest rate going up or interest rate coming down? As an issuer, think from an issuer point of view. When you will exercise the bond? When you will call the bond? When interest rate going down, you will exercise the bond. Why you will exercise? Simply because you want to pay 6% instead of 9%. Correct? If you are exercising the bond in 6%, that is in exercising the bond in lower interest rate, you will lapse the option to buy the bond in higher interest rate. That is simple. Okay, simply this would be opposite of each other. Similarly, see, if callable bond is what happens to the investor when issuers buy back. The what happens to the investor when issuer buy back? When issuer buy back the bond, he gives the capital or the principal amount or price of the bond to the investor there itself. So if let's suppose I have buy back the bond in 2 years, I will pay you the price of the bond and you will have to give me back the bond. This is what happens when an issuer buybacks. Lapse means basically not exercising. Making the bond lapsed means basically not exercising the bond. Can the investor reinvest in the same bond with the new interest rate? Yeah, he can do so. That is perfectly fine. Soumya, are you clear with this? Interest rate going up, interest rate going down. Simply when you are not exercising the option, you are making the option get lapsed. Soumya, are you clear with this? Soumya? Okay. There are various risks associated with the bonds. Although bond is a fixed income security, but still there are risks associated to the bond. First is interest rate risk. As I said, when interest rate goes up, bond prices fall. When interest rate goes down, bond prices increase. So what is the risk? If interest rate goes up, prices of the bond will keep on falling. Second risk is reinvestment risk. And reinvestment risk is associated with callable bonds. Remember, because issuer has the right to call the bond. So will we be able to reinvest the amount that is taken by that we have got back at the same return? That is my reinvestment risk. Third one is credit risk of downgrade and default. Simple concept of finance, one of the most basic concept of finance says that higher the risk, higher the return. Basically, let's say you have two options to invest in bonds. Interest rate risk means when interest rate goes up, prices of the bond fall. So if you are investing in a bond, you are afraid of interest rate rising. We saw while valuing the bond and pricing the bond that how interest rate affects the price of the bond. We saw that while valuation and pricing of the bond in the second class, I guess, regarding fixed income securities. Or first class maybe. Okay, SG, remember that? If interest rate goes up, prices fall. Would you want prices of your investment to fall? No. That is why you are afraid of interest rate rising. Correct? Clear, everyone? Shall I go ahead? Let's say you have two options to invest in bonds. One of Reliance Industries and one of a startup. In which bond will you invest? In which bond will you invest? Will you invest in bonds of Reliance Industries or will you invest in the bonds of a startup? Soumya is saying startup. Rest every one of you are saying Reliance Industries. Soumya, please let me know. Correct. Very good, GA. Correct. PJ, you are correct. One thing that you should ask yourself is what is the return that Reliance and startup is giving you? If Reliance is giving you 8% and startup is giving you 8%, then definitely you will invest in Reliance Industry. But if Reliance is giving you 12% return and startup is giving you 18% return, it means that startup is compensating you for the higher risk that you are going to take. Startup is compensating you for the higher risk that you are going to take. Okay. So if you are an investor who loves high risk and high return, then you will be investing in a startup. Whereas if you are a conservative investor who want to play safe, then you will be investing in a bond issued by Reliance Industry. Now, why startup is giving you 18% return? Why startup is more risky? What is the risk associated to the startup? The risk associated to the startup that is probably he won't be able to pay back your principal, won't be able to pay back face value, probably whether you know company or you don't know company, you are concerned about your interest and your face value or your return of principal. So the two things that you are concerned about is won't be able to pay back the face value. And the second, yes, let us get done with this, then we will take break, SG. Okay. Won't be able to pay back the face value. That is the first part. What is the second part? The second part is probably the startup won't be able to pay coupon on time. That is also a risk. So basically what happens, there is something called as a credit rating agency. There is a credit rating agency which assigns credit rating to various companies. The credit rating are as follows: AAA, AA, A. Coupon is interest returns. Consider for now coupon as interest return. We have already discussed what is coupon, how coupon amount is calculated. So coupon is basically interest that the company pays. So if the company is a startup, he won't be having stable cash flows. There is no certainty that he will the company is going to pay you back the interest. Okay, Soumya. Now credit rating agency assigns rating to various bonds. AAA, AA, triple B, double B, C. So basically what happens, AAA rating is a premium quality credit rating. It means that the bond has very low chances of default or in fact safe asset. Bond is safe to invest. Double A comes below AAA, triple B, double B, C. From top to bottom, you go on deteriorating credit rating. So when you go for a lower credit rating bond, yes, so there are various, there is S&P and then there is CRISIL, which is a Indian arm for S&P. Then there is Moody's. Various credit rating agencies have their own standards of default. Some might follow AAA, AA, triple B, double B, C. This standard, some might follow A++, A+, B++, double B+, and all these. So this depends and differs from agency to agency. But the idea is this is how the bonds are rated. This is how the bonds are actually rated. Now the question is, as you go lower and lower towards the credit rated bonds, lower and lower credit rating bonds. CIBIL score is basically for an individual, whether what is the probability of an individual to pay back the loan based on the repayment and borrowings that he has made in the past. Credit rating is in case of the corporates and large businesses. Okay, as you go lower and lower towards the credit rating bond, whether you are assuming higher risk or lower risk, a lower credit rating bond will come with a higher risk or a lower risk. What is this, Priyanka? 66, 74, 458, 85, 785. As we go from lower credit rating bond to, as we go towards a lower credit rating bond, lower credit rating bond will come with a higher risk. And a higher risk bond would give you a higher return or a lower return, at least the expected return. A higher risk bond will give you a higher expected return or lower expected return. Higher returns. And when will the returns will be higher? When the prices are higher or prices are lower. When the prices are higher, then the returns would be higher, or the prices are lower, then the returns would be higher. Something, if you buy for 100 rupees and sell it to 500 rupees, then you would make more returns, or something that you would buy for 450 rupees and sell it for 500 rupees, then you will make more returns. So if prices are lower, you will be making more returns, right? So what happens when a credit rating agency downgrades a bond? When a credit rating agency downgrades a bond, the prices of bond falls down. The prices of bonds falls down. So that is credit risk. Credit risk for the bond. Next is liquidity risk. Liquidity risk. What is liquidity risk? Basically, liquidity risk is, what is liquidity? Liquidity is ability of an asset to be sold at right price. Ability of an asset to be, yes, I will explain that, Pooja, just give me a second. Is it okay, Pooja, if I explain you that during the break? Because there are 3 points more remaining, and then we will be done. Okay. The ability of an asset to be sold at right price. Let's suppose you have purchased a bond, but you are not able to sell back the bond to anyone else. So that is illiquidity of a bond. This bond would be told illiquid because it cannot easily be sold at the right price. Bond also has inflation risk. So let's suppose if you have invested 1000 rupees and you are getting 8% return, and inflation in the market is 12%, basically your money will lose out its value. Money will lose out its value. So that is why bond comes up with an inflation risk as well. And then there is exchange rate risk. If rupee is consistently depreciating and you are getting returns in rupees, you are actually losing money. And finally, volatility risk. As interest rate goes up or interest rate goes down, the price of the bond moves up and moves down. And that is what volatility is. The movement of the bond up or down, movement in the prices of the bond and up, is called volatility risk. So guys, this was about the risk associated to the bond. There are few more points to cover in fixed income. Those who want to go on a break, please go on a break, but be right back on time. Be right back in next 5 minutes. Meanwhile, let me explain this. credit rating part to PP. Okay. Please explain inflation. So let's suppose something was available at 100 rupees and at 12% return, it will be available to you at 112. Something was available to you at 100 rupees and now at 12% inflation, it is available to you at 112 rupees. Okay. But you invested in a bond which was giving you 8% return. When you invested, you were able to buy that, let's say, apples for 100 rupees. But when you redeemed at 108, that is the future value, will you be able to buy those apples? Because now apples are costing you 112 rupees. And why these apples are not no more affordable to you? Because inflation rate outperformed your return on bonds. Inflation rate outperformed your return on bonds. That is why inflation is the risk associated to bonds. Clear? Are you clear with this, K? Even Soumya, what is exchange rate risk? Let's suppose rupee per dollar was 64 rupees. And now rupee per dollar is 84 rupees. Since you invested in rupees, you will be getting return in rupees. Let's say you got return after 5 years. You invested $1 for 64 rupees, and after few returns, you although got 80 rupees. But still, since rupees has depreciated to 84, will you be getting $1 instead of this 80 rupees? The answer is no. Because for getting $1, you want 84 rupees now. So even though you generated percentage returns in bonds, it doesn't mean you would be able to take that bond to your native place, or maybe a US investor investing in rupees may not surely be able to take that bond at the exact value. So interest rate risk, or sorry, exchange risk is also a factor while investing in fixed income securities. Okay. Coming to PP, basically, there are two people who pays interest on time. PP, are you there with me? Okay. There are two people one who pays interest on time and one who does not pay interest. So one who does not pay interest has defaulted on his loan. This is called default. When you are not able to pay back the amount that you have taken, that is called default. Who would bank be providing loan at a lower interest rate? Basically, giving loan to whom is less risky? Giving loan to which person is less risky? Giving loan to the person who is paying interest on time is less risky because he has paid all his past interest on time. So he is expected to pay the similar, he is expected to maintain a similar attitude in future as well. On the other hand, the one who has defaulted, giving loan to him is highly risky. Since this is highly risky, there he has a credit rating of triple B. And since this is a good person, he has a credit rating of triple A. This credit, so you remember toppers used to get A plus, A plus plus in their report cards. This is basically report card of a borrower. This is basically credit rating is nothing but a report card of a borrower, that how well he has obligated his bonds or paid off his interest rates and principal repayments on time. Based on that, he is getting a report card, which is credit rating report or credit report. So that was credit report, and higher the credit rating, lower will be the interest taken by the issuer. Lower will be the interest for the bond which will be issued. Higher the credit rating of the issuer, safer the asset, and safer the asset, lower will be the issue price of the bond. The more safe the asset is, the lower will be the asset price of the bond. Okay. Let me just download this and give it to you. Yes, obviously it would be uploaded on LMS also. 10 different agencies raised same issuers differently. There could be a slight difference, but there won't be a major difference. Like one could not issue one investor as AAA and the other one as completely C. So that is something that won't happen very often. If interest rate increase and bond value gets down, then it is possible on maturity amount will also gets down. No, if you are holding the bond till maturity, then you will be getting stable return. You won't be getting fluctuating return because at maturity face value is fixed. Maturity amount won't get down. Please, Veera, VM, please mention your doubt in the chat box. No, duration is not, that is something covered. Macaulay duration and modified duration, that is not the part of the discussion or part of the curriculum. Yes, okay, those notes in PDF format, I guess, would have been uploaded on LMS. So please check your LMS for that. VM, please know what do you wish to clarify. So for that, you can raise a ticket and we can have a one-to-one session, PM. Just rate how much percentage on face value changes. Is there any calculation available? How much interest rate increase impact how much percentage on face value? So as I said, Priyanka, face value won't change. The amount at maturity is fixed and it would never change. But the price of the bond changes. And how the price of the bond changes, that we saw while doing the pricing and valuation of fixed income securities and pricing and valuation of bond. So if interest rate is increasing by 1%, what would be the change in price of the bond, that we actually saw while doing the pricing and valuation part, if you remember. Sure, GA, definitely. But mention in the ticket that what topic you want to discuss, and we can have a discussion over it. Understand it, don't memorize it, KG, but it is just for your revision purpose. Now there are few yields. First one is current yield. Current yield is basically, what is yield? So Arjun, if that is the case, please raise the ticket. The team will get in touch with you. What is yield? Yield is return. And when we talk about, yes, Sikandar, please let me know if you have any doubt. Sikandar, please. Okay. Current yield is basically returns. What are yields? Yields are return. Now, what does this word current says? Current says recent, now, and while being in the bond, while investing in the bond, what do we get now? We get coupon. What we get later? Later we get face value. So if I invest something today, what is the current yield? Yield in today's term that I will generate. So coupon, the formula for current yield is coupon upon current price of the bond. Coupon upon current bond price will give you current yield for the bond. Okay. So annual coupon rate, this is in annual terms. Annual coupon rate divided by current price, we get current yield. Then what is yield to maturity? What is yield to maturity? Already we discussed this. Anyone remember the explanation given for yield to maturity? What is yield to maturity? Please, anyone, I would be very happy to get this as an explanation in the chat box. Yield to maturity is basically the returns if you hold the bond till maturity. The returns if you hold the bond till maturity. Correct? Yield to maturity has two components: return from coupon and return from capital appreciation. If you remember what I said, let's suppose you invested in a bond which is priced at 800, maturity is 3 years, face value is 1000, and coupon rate is 10%. So 10% is the return, 100 rupees is the return that you will get every year for the next 3 years. But at the end of third year, you would also get the face value worth 1000. So when you invested, you got 800, you invested 800 and got 1000. So along with this 10%, you also enjoyed this capital appreciation of 200 rupees. So incorporating this capital appreciation with coupon gives you yield till maturity. Okay, everyone. Now there is a concept of accrued interest. Now what is accrued interest? Let's say there is a bond, there is a 1 year bond, which pays semi-annual coupon. This is 3 months, this is 6 months, this is 9 months, and this is 12 months, that is 1 year. Let's say the bond has face value of 1000 and coupon rate is 10%. Coupon rate is 10%. Now, this, according to this, 50 rupees, let's say the coupon rate is 20%, so 10% will be achieved every year. Coupon frequency is semi-annual. Coupon frequency is semi-annual. So after 6 months, every 6 months you will receive. No, coupon frequency is semi-annual, coupon rate is annual. Yes, coupon rate is annual. and coupon frequency is semi-annual. So coupon you will receive is 100 rupees here and 100 rupees over here as well. Now the question is, if I sold the bond over here, coupon frequency is semi-annual, not quarterly, but semi-annual. I am just made the timeline quarterly. I will tell you why, but the coupon frequency is semi-annual only. It's 20%. Coupon rate is 20%. 20% per annum. So 200 one in first 6 months, 100 in first 6 months, 100 in next 6 months. So 20, always remember coupon rate and YTM is always quoted per annum. This is in annual terms. So 200, and since this is semi-annual, you will be receiving coupon every 6 months. 100 rupees received over here, 100 rupees received over here. Let's say I sold the bond in 9th month. At the end of 9 months, I sold the bond. Now the question is, this 100 rupees is basically interest for the last 6 months that I received. 50 rupees for this month, 50 rupees for this month. This is approximate values. Correct? 50 rupees for this month, 50 rupees for this month. Now, the next coupon that is to be received is 100 rupees over here. This and this will be, let's say, I bought the bond. I am A. A bought the bond. A sold the bond to B. A sold the bond to whom? A sold the bond to B. The question is over here, when the bond will receive 100 rupees coupon, this will be received by whom? This will be received by A or this will be received by B? Please bear with me, guys. Please pay 100% of your attention over here. Again, I will repeat what has happened till now because this is somewhat very confusing. I am explaining again what is happening. I am explaining again what is happening. This bond pays semi-annual coupon 100 rupees every 6 months at the face value of 1000. So 100 rupees is received in the first 6 months and 100 rupees is received in the next 6 months. A bought the bond at the start of the year and after 9 months sold the bond to B. Anyone has doubt till here? A sold the bond to B. Anyone has doubt till here? A sold the bond to B. The question is, after 12 months, when the bond will receive coupon, will that coupon be received by A or B? So every one of you are saying B will receive this coupon, correct? But this 100 rupees is basically the interest for the last 6 months. You are correct that owner of the bond should receive the coupon. Owner of the bond should receive the coupon. That you are correct about. But my dear friends, for the first 3 months, don't you think A was the owner of the bond? So A deserved the coupon for the first 3 months and B was the owner of the bond for the next 3 months. So B deserved the coupon for the next 3 months. Don't you think this is the case? Don't you think this should be the case? Yes, KV, you said A, but does A deserves the whole 100 rupees? No. The owner of the bond should get the return. The owner of the bond should get the return. So since this 100 rupees is basically the interest on the last 6 months, the first 3 months coupon will be received by A and the next 3 months coupon will be received by B. So the first 3 months of coupon that should be received by A and actually is received by B is basically the accrued interest. Is basically the accrued interest. But how the issuer will get to know? So basically, how the issuer gets to know? Let's say DK, do you invest in shares? DK is saying, how will the issuer gets to know that the bond has been sold to B? How instead of paying the interest in A's account, issuer will pay the bond in B's account. Correct, DK? This is your question. DK, do you invest in shares? So when you buy the shares from someone else, if you hold the shares, you get the dividends, correct? If you sold the share to someone else, the one you have sold, it will get the dividend. Yes, yes, KK, you are correct. So basically, the dividend gets to the owner, right? Similarly, they will tap on the bank account to the owner of the security. Okay. So that was accrued interest. Anyone has doubt in accrued interest? Anyone has doubt in accrued interest? Now, what is the formula? Coming accrued interest is basically a numeric term. Okay. Okay. I will repeat this. Basically, A sold the bond to B in 9th month. SK, you were there with me till here? No, the issuer won't pay half the interest to A and half to B. Issuer will simply pay the interest to B. But B will pay the interest to A here itself. B will pay the interest to A here itself. We will come to that how. Priyanka is saying, what if B denied to pay the interest? Priyanka is saying, what if B denied to pay the interest? Priyanka, yes, there is an obligation. If won't pay the interest here itself while making the deal, A won't sell the shares to B, right? And please believe me, although we are not the country who invest much in bonds, but this is like same like shares. So if Reliance is selling shares, Reliance shares are selling for 2000 rupees, and you want to buy in deny Reliance shares, Priyanka, would you deny paying 2000 rupees? Does that make any sense? If you want Reliance shares, simply you should pay 2000 rupees. Does that make any sense? You will deny that simply if the bond is priced based on the coupon and the accrued interest. B is interested in buying the bond. B has to pay it. There is no denial in that. This is not the over the counter trade. This has been traded on exchange. To make it practical, we discuss it. To make you understand, we discuss it while going for much in depth, but we should not forget common sense over here. No, after 3 months, B won't pay. B will pay the interest here itself. Along with the price, B will pay the interest. But give me some time. Give me some time. I will come to that. There we will have to introduce the concept of clean price or dirty price. Okay, but SK has not understood this. SK, the 100 rupees that should be received after this 6 months will be received by whom? Whether by A or whether by B. SK Subrata, I am talking to you. The 100 rupees that is received will be received by A or received by B. This 100 rupees, let's suppose you have sold the bond. A has sold the bond to B. Yes, I am explaining again in short. Arjun, you bought the bond. Arjun bought the bond in year 0. In 6th month, 100 rupees was received by Arjun as a coupon payment. The next coupon will be received after 12 months. But in midway, during 9 months, Arjun sold the bond to Subrata. Arjun sold the bond to Subrata. Now tell me, Arjun, if you sold the bond to Subrata and coupon is received in 12th month, who deserves that coupon? Whether Subrata deserves that coupon or whether you deserve that coupon? Arjun, whether you deserve that coupon or whether Subrata deserve that coupon? Please reply, Arjun. You asked me to repeat and I have repeated it for you. The question is, both deserves coupon. Arjun deserves coupon for the period he had hold the bond, and Subrata deserves the coupon for the period he had hold the bond. So the coupon should be divided among both, and the interest payment that Arjun should receive for these 3 months, the interest payment that Arjun should receive for these 3 months is basically accrued interest. Interest payment that Arjun should receive for these 3 months for which he has held the bond is called accrued interest. So someone was asking for definition. Accrued interest is a numeric term and has a formula for it. So what is the formula for accrued interest? Face value multiplied by coupon rate. Can I write face value multiplied by coupon rate as coupon amount? A is basically forfeiting the right to yield coupon as they no longer hold the bond for 3 months. Yes, you will be more clear with this, Batlan sir. Just let me get done with this. Face value into coupon rate, and this is annual coupon rate. To calculate periodic coupon, we have to divide by number of coupon payments. Coupon amount divided by number of coupon payments. Guys, can I take a sip of water and be right back in a second? Perfect. So face value multiplied by annual coupon rate gives me coupon amount. And when this coupon amount divided by number of payments, what do I get? I get periodic coupon amount. Let's say there was a bond which has face value of 100, pays coupon rate 20%, and frequency is semi-annual. Without looking into this formula, tell me with the logic that we have understood, what would be the coupon amount per period? What would be the coupon amount after every 6 months? 10 rupees. Very good. 100 rupees is the face value. So 10 rupees would be the coupon amount. So basically, what is this periodic coupon amount? This is this 10 rupees. Okay. So what is accrued interest? Periodic coupon amount multiplied by days since last payment date divide by number of days between payments. Looking into our example, don't worry if you are getting confused in this. When we will link this to our example, you will be crystal clear with this point. Apply the same formula in our example that we discussed in the last slide over here, and give me what is accrued interest. Give me accrued interest. Apply the same formula and give me what is accrued interest. $100 into 3 months divided by 6 months, 1/2 will be 50 rupees. And this is what we understood through logic. So for 50 rupees, A will get the coupon, that is Arjun will get the coupon, and for 3 months, SK will get the coupon, 50 rupees and 50 rupees. This coupon will be split between these two people. Clear, guys? Clear with accrued interest part? Okay. Now there is a concept of clean price. Clean price is equals to dirty price minus accrued interest. Clean price is equals to dirty price. 100 where comes from? Okay, 1000 into 20% was 200. And since it means that in a year you will receive 200 as coupon. In a year you will receive 200 as coupon. But since you are receiving semi-annual coupon, the coupon received every 6 months is 100 rupees and 100 rupees. Okay, Sikandar? Sikandar, are you clear with this? Clean price is equals to dirty price minus accrued interest. Dirty price is equals to clean price. Coming to that, what is dirty price and what is clean price? Also applicable if coupon paid annually and investors sell the bond after 5 months. Yes, obviously it would be available. It would be applicable in that case as well. If the investor sells midway, accrued interest will be applicable. Dirty price is equals to clean price plus accrued interest. What I mean by that? Let's say dirty price, again writing the formula in the new slide, dirty price is equals to clean price plus accrued interest. So let's say if the price of the bond is, if the price of the bond in today's term is 900, that is after 9 months. After 9 months, the price of the bond is 900. It means that A sold the bond to B, Arjun sold the bond to Subrata for 900. Arjun quoted the price for 900 actually. So this 900, how it is derived? It is derived using the valuation method that we followed. But out of this 900, only 850 belongs to Arjun. Only 850 belongs to Arjun. Rest 50 rupees is belong to, sorry, only 850 belongs to Arjun. And from the price over here. And the rest 50 rupees is the part of accrued interest. So the price of the bond was 850 and 50 rupees is the accrued interest that SK has, Subrata has to pay to Arjun. Why? Because later Subrata will receive 100 rupees coupon. Remember, later Subrata will receive 100 rupees coupon. And since that 100 rupees will totally belong to Subrata, he should here itself pay Arjun that 50 rupees that Arjun deserves. So what is dirty price? Dirty price is basically a price that includes accrued interest. Clean price is a price that does not include accrued interest. Okay, everyone comfortable? Moving on. Basically conventions. While calculating the clean price and dirty price, while you want definition for dirty price? Wait, I'll give the definition. Let me define dirty price for Khushbu. A bond price that includes the accrued interest component in its cost is dirty price. Now, here bonds are priced. Bonds are available for 1 year. Bonds are available for 1 year. And in 1 year, bond pay coupon in between. In 6 months, maybe after every 3 months. So 0, 3 month, 6 month, 12 month, 9 month. But how many days are there in a year? How many days are there in a year? 365. What is 365 divided by 4? What is 365 divided by 4? 91 point something. 91.25. How is it possible to pay interest in 91.25 days? This will, although it is possible, but this will create confusion, right? How it would make calculations a bit difficult to calculate coupon payments for every 91.25 days. Don't you think so, guys? So to make this simple, bond market consider 360-day a year period. 360-day year period. There are two major reasons for this. One, when divided by 2 or divided by 3, or sorry, when divided by 2 or divided by 4, it gives a whole number that is 90, 90, 90, and 90. So it makes calculation little bit easy. And the second thing is, if there is in some year we get 365 days a year, in some year we get 366 days a year. So it ignores that impact as well. It mitigates that impact of leap year as well. So to make calculation easy, bond market follows the convention for 360 days a year period. But remember what I told about money market? Remember, guys, what I told about money market? It is the market for securities for less than 1 year, basically less than 365 days. So if money market security is rounded off for 360 days, basically investor will lose interest for 5 days. Correct? Bond market securities are for long term. So 5 days interest won't matter much and will be incorporated in this 360-day convention. But if money market uses this convention, investor will use a major chunk. What is 5 divided by 365? Give me 5 divided by 365. 0.013, so 1.37%. So 1.37%, which is a greater return in case of money market, will be ignored if money market uses 360 days convention. So money market always follow 365 days convention. Money market always follow 365 days convention. Now, final point with which can we extend the session for more 5 minutes and make the final point and conclude our session with fixed income securities. Final point is securitization. Let's suppose there is a bank. which has assets which has liabilities and assets in their balance sheet. So those who don't know what are assets, or assets are basically items that we own, and liabilities are the items that we have borrowed. Now, in the asset side of the bank, there would be loans, receivables, receivables for the bank, let's say worth 1000 crore, 1000 million. Let's say in the asset side of the bank, there are loans worth 1000 million. And some of these loans are non-performing loans. Heard this word, non-performing assets? Some of these assets are non-performing assets. It means that out of these loans, some of them have defaulted. So what can bank do about it is, bank can create a pool of this 1000 million of assets and sell it to a independent entity that is called SPE. What does SPE stands for? Special Purpose Entity. What would special purpose entity do? Special purpose would buy this 1000 million worth of loans at a discounted price, probably 800 million, let's say. So 1000 million of assets has been transferred to SPE, and SPE will provide 800 million. How does banks benefit? How did the bank benefit it? Bank got 800 million in liquidity, that is in cash. Bank can lend out this money to other people and increase their business. How does SPE benefited? He got 1000 million of assets at 800 million. Now let's suppose if SPE is able to recover now 900 million out of it, then SPE is in profit. And if SPE is able to recover 750 million out of it, that is any number below 800 million, then SPE is at a loss. Now, who are these SPE? These are credit rating agencies. Yes, there are losses, but PJ is asking that to compensate the loss, it is not about compensating the loss, PJ. I never said that the loans, the asset pool has been sold to SPE to compensate the loss. Banks are in the business of providing loans, right? More money they have, more will they be able to provide with the loans. And some of those assets in this pool was non-performing assets. Since bank wanted cash now, probably bank could get this 800 million now, invest it in a better return and make that 1100 million. That is the benefit for the bank. Bank could do business from this 800 million and make this 1100 million. That is the benefit for the bank. Are you getting this, PJ? Since these are non-performing assets, bank would have not benefited keeping this in their balance sheet. They won't have cash to lend out. Since now they have cash, they are able to lend it out. Now, who are these SPEs? These SPEs are credit rating agencies, correct, sir? Like Moody's. Correct, Apurva, sir? Like Moody's. They evaluate the pool of assets, and based on that, they buy those pool of assets from bank, provide the money at a discounted rate. And how will the price determine? What will be the rate at which the price will be determined? that will be taken care by SPEs by evaluating the underlying asset. They will evaluate the quality of asset. Better quality means low discount. They will evaluate this asset, issue the securities called as MBS, mortgage-backed securities and asset-backed securities, issue the securities, collect money from the investors, and these are investors. SPE will collect money from them by issuing them securities, give this money to the bank. Let's say 800 million collected, 1000 million of pool of asset of 1000 million is available with SPE. Recollect the money from this pool. Let's say 900 is recovered and transfer this money to the investors. This is how securitization works. This is called off balance sheet transaction, taking off your asset from your balance sheet. This is called securitization, converting assets into securities. So that was all about today, guys. Okay, Priyanka, what did you didn't understand about this? And how many of you didn't understood anything about this? Only Priyanka? Prachi got it. Perfect. Why is securitization needed? Simply because these assets were not helping the bank. Priyanka is saying, why is securitization needed? Because these assets were not helping the bank to increase their business. Now bank has more money by exchange of these assets. Will having loans receivable in your balance sheet and not getting loans help you with growing your business as a bank? No. So you have money now. You can invest that money to get the liquidity and more profits from the assets. Yes, correct. So to get the money now and invest that money by providing loans and earn profit. Not all the assets are NPA. If all the assets are NPA, non-performing assets, some of these assets are NPA, and what percentage of these assets will be completely not performing will be determined by SPE, special purpose entity, because they specialize on evaluating the underwriting asset or evaluate determining the quality of asset. Remember, we used credit rating agencies for evaluating credit ratings. So these agencies will evaluate the credit rating of all the assets that is in the underlying pool of assets. And based on that, they will determine the price. If all of the assets are non-performing ones and they are not expected to pay you back, why would SP buy those assets? Think about it. It is also called bankruptcy remote vehicle. Simply because in the event of bankruptcy, these receivables are no longer with the bank now. It is with the special purpose entity. So the liability holders can't have claim over this. That is why it is called bankruptcy remote vehicle. Sir, tomorrow our class is large. Could you tell me what will happen after tomorrow's class? So Vishal, yes, they have to mention that. They have to mention that, Priyanka. So after tomorrow's class, you will be having your exams, subjective and objective exams, Vishal. And with subjective and objective exams, you will also need to schedule your mock interviews and you will be assigned a project based on DC evaluation. And that project you will have to complete. How these securities are called asset-backed securities. So there are various loans. These loans are assets for the bank. And since those assets are the underlying assets for the behind those securities, these securities are issued by the SPE based on these underlying securities. These are called asset-backed securities. If all these assets would have been home loans or mortgages, it would have been called mortgage-backed securities. No, for project, you will have to make your own. Yes, no, it's not tomorrow. You will be receiving project and mails about it. Don't get it confused. So those who will be done with the classes, all the lectures tomorrow, that is batch which was started in January. So make sure, guys, that after this class, you be in touch with the subject. You will be having your mock interviews. You will be having your uh, subjective and objective exams. You will have to make a DCF project. And after that, there will be your placement rounds conducted. This is what is being informed to me. So based on that, I am sharing these reviews. If you want anything, any details regarding it in detail, please let me know. So you have 6 objectives and 6 subjective exam. You need more time to prepare. If you want to request an extension, please raise a ticket about it, SK. I'm sorry, but I won't be able to help you out on this. So if you are well prepared, KK, you can give the test. No, TB, I am not aware about the schedule of the exam. You will receive mail about it. That is not something. So you can take the test. And if you are having any trouble accessing it, you can raise a ticket about it. When will the exam held? You can raise a ticket about the schedules of the exam and anything other than this related to anything other than the curriculum. You can raise a ticket about it. If you have any doubts in the curriculum as well, you can request for a one-to-one session or the resolution for the doubt. I will send you a text message and in the ticket itself. How many classes are left? So this is around 5.5 to 6 months of lectures. So based on that, calculate when you started and how many months are left for your respective batch. So the people who joined in January, tomorrow you guys will be having your last class. I don't know, SK, please raise a ticket about it and get it assured from them. The respective team will get in touch with you and they will let you know. Sure, we will be finishing tomorrow for Jan batch. Thank you guys. Thanks a lot. Bye-bye. Have fun. See you guys tomorrow. Keep on revising the concepts. Don't lose the touch with the topic. In financial modeling, the project is only on DCF, although we have relative valuation models and other valuation models, merger and acquisition, LBO models as well. Yes, Devendra, did you ask anything? Please mention again. I think your message is lost in the pool of messages. Yes. Those who are done can leave. Mock interviews will be held. Everything regarding the schedule, you can raise a ticket about it. I won't be the best person to comment on the schedule because I am myself not aware about it. So you will have to raise a ticket about it. The team will get in touch with you and you can ask for them the schedule that you wish to about interviews, mock interviews, placements, and everything apart from the curriculum. If you have any doubts regarding the curriculum, you can ask me, DK. So VK is asking for how long the video will you will have access to this video. I'm not sure about it. Probably 1 year, 1 year or something. So again, raise a ticket about it if it is not related to curriculum. Again, I want to be very clear, guys. Here, I am only there for delivering lectures and providing you with the quality content. I have never been associated with scheduling team. I have never been associated with placement team, internship team, and uh, with the mock interviews as well. I have never been the part of that process. So I won't be the best person to comment you on that. So thank you guys. Thanks a lot. If you have any doubts, you can raise a ticket. See you guys tomorrow. The session has been extended. Sorry for that. Be right back on time tomorrow. Bye-bye. Take care. Have fun. That is also something, SK, you can ask the team about it and they will help you out on this. Bye-bye, friends. Have fun. Thank you. Thanks a lot.